Hi dear, welcome to Trader's Mind Code. Crypto Secrets They Don't Want You to Know, 2025 Step-by-Step Guide. Why read this book? This book unlocks the hidden truths and insider secrets of the crypto world that many won't tell you. Whether you're a beginner or an experienced investor, it offers clear, step-by-step guidance to navigate the complex blockchain landscape, avoid costly mistakes, and build real wealth in 2025 and beyond. If you want to understand crypto beyond the hype and take control of your financial future, this is the essential guide you've been waiting for. Introduction. Behind the curtain of crypto, they don't want you to know this. But just by choosing to listen, you've taken your first real step toward financial freedom. In the world of crypto, there's a curtain, a digital barrier made of buzzwords, hype, and confusion. Most people only see what's on the surface. Headlines shouting about Bitcoin crashes or overnight millionaires, influencers pushing the next big token, or the chaotic swings of the market. But almost no one talks about what's behind the curtain. That's why this book exists. Crypto Secrets They Don't Want You to Know, 2025 Step-by-Step Guide, was written to pull that curtain back, to reveal the truth, the system behind the system. It's not just about coins, charts, or speculation. It's about control, information, power, and most of all, freedom. This book is your key. Why this book matters now. The timing is not random. In 2025, crypto is no longer a fringe experiment. Banks are experimenting with their own digital currencies. Politicians are scrambling to regulate something they barely understand. Major companies are using blockchain while denying its power in public, and still, most people are left in the dark. You're here because you know there's something more. You've seen the signs, heard the noise, and felt the shift. Maybe you've asked yourself, is crypto really the future? Or is it just another trap, dressed up in tech? Who really benefits from all of this? The truth is, crypto is not going away. And if you don't understand it now, you risk being left behind later. This book will change that. The truth they hope you never learn. What you've been told about crypto is mostly noise. The truth is, most of the influencers shouting about coins are being paid behind the scenes. Most crypto projects aren't solving real problems. They're just buzzwords stacked on top of thin air. Many platforms are built to benefit the creators, not the users. And yet, within this chaos, some people are building real wealth. Quietly, intelligently, without the hype. They're following frameworks, applying long-term thinking, using knowledge, not noise. That's what you'll learn in this audiobook. No hype, no false promises, just clear, powerful information you can use. Who this book is for. You don't need to be a tech genius, a Wall Street trader, or a blockchain developer to benefit from this. This book is for anyone who wants to escape financial dependence and explore real alternatives, feels overwhelmed by crypto, but curious to understand it, has dabbled, lost money, or just doesn't know where to start, is ready to think critically and act smartly. If that sounds like you, you're exactly where you need to be. How to listen to this book. This is a journey, not a lecture. Each chapter is designed to be listened to, absorbed, and applied. You can go straight through or jump to the chapters that call to you most. Either way, I encourage you to pause, reflect, and take action where needed. I'll walk you through everything, step by step, in clear, simple terms. And at every stage, you'll gain confidence and clarity. This isn't just about theory. This is about real, usable knowledge. Chapter 1. The Hidden History of Crypto. When most people hear the word crypto, they think of headlines, price spikes, crashes, scams, Elon Musk tweets. Maybe they think of Bitcoin. Maybe they think of that friend who got rich or went broke overnight. But few stop to ask a deeper question. Where did this all begin? Not just how crypto started, but why it started. Because once you understand the roots of cryptocurrency, everything else starts to make sense. The volatility, the fear, the resistance, even the manipulation. This chapter is not about technology. It's about motivation, about truth, about revolution. Let's go back to where it all began. The spark before the fire. To understand crypto, you have to go back to a time when trust in the financial system was crumbling. The year was 2008. That the global economy was collapsing. Major banks were failing. Millions lost their homes, their jobs, their retirement savings. Governments bailed out the very institutions that caused the crisis, while everyday people suffered in silence. Confidence in the traditional financial system was shattered. People were angry, hopeless, and asking the question that would change everything. What if we didn't need banks to control our money? In the shadows of that chaos, a white paper appeared online. The birth of Bitcoin on October 31st, 2008, a person, or perhaps a group, under the name Satoshi Nakamoto published a 9-page paper titled Bitcoin, a peer-to-peer electronic cash system. It was simple, quiet, and revolutionary. The idea was this: money that didn't rely on banks, middlemen, or governments. A decentralized system where people could send money directly to each other, securely, anonymously, without needing permission. Just 3 months later, on January 3rd, 2009, the first block of Bitcoin was mined. It was called the Genesis block, but here's what made it legendary. Embedded inside that first block was a hidden message. The time 03/Jan/2009 Chancellor on brink of second bailout for banks. This wasn't random. It was a statement, a timestamp, and a warning. Satoshi wasn't just launching a new currency. He was exposing the flaws of the old system. Bitcoin was born as a protest, a technological act of defiance, a silent revolution. The rise of the underground economy. For years, Bitcoin lived in the shadows. It was used by a small group of cryptographers, libertarians, and tech enthusiasts who believed in freedom through code. Mainstream media ignored it. Banks laughed at it. Regulators dismissed it. But slowly, something changed. People started realizing that Bitcoin wasn't just an experiment. It worked. You could send money across the world in minutes, without permission, borders, or banks. You could store value without inflation eating it away. You could opt out of the system that had failed. You and others took notice. Developers began building new coins, new networks, new tools. Ethereum launched in 2015, introducing the world to smart contracts, code that could automate agreements, apps, even entire organizations. Crypto was evolving fast. Enter the institutions, and the inevitable power shift. At first, governments and big banks laughed. Then they got nervous. Then they got involved. Between 2017 and 2020, crypto went from a niche underground movement to a global asset class. Hedge funds, billionaires, and corporations started investing. Exchanges like Coinbase went public. Celebrities launched tokens. Even governments started testing digital currencies. But something important happened along the way. The movement that started as a rebellion slowly became a market. And with that shift came the same forces that the crypto revolution was trying to escape: greed, manipulation, centralization. The wolves had entered the castle. This is why so many people today feel confused. They hear terms like decentralization, freedom, and financial sovereignty, yet see platforms, influencers, and tokens behaving just like Wall Street. The crypto world isn't broken. It's evolving, but not everyone wants you to understand the difference between real crypto values and the hype machine that's been built on top of it. Why you've only heard half the story. Here's a hard truth. Most people only hear what they're meant to hear. The media pushes the extremes, the crashes, the hacks, the overnight riches. Politicians frame it as a danger. Banks call it a threat. Meanwhile, crypto influencers create drama just to sell you the next coin. But the real story? The real story is quiet, underground. It's not loud. It's powerful. That it's happening in countries where people are using Bitcoin to escape hyperinflation, that it's happening in companies building tools that could one day replace banks altogether. It's happening in developers, coders, thinkers who still believe in what Satoshi believed in: a future where you control your money, your identity, your choices, and that is what they don't want you to know. Chapter 2: Decoding Blockchain. What they complicate on purpose. Ask the average person what blockchain is, and you'll get one of two answers: a blank stare or a confusing explanation full of technical words like distributed ledger, hash functions, consensus protocols, and cryptographic timestamps. It's no accident. The truth is, blockchain isn't that complicated. But certain people, developers, institutions, even influencers, want you to think it is. Why? Because if it sounds too complex, most people will give up on trying to understand it. And when people don't understand something, they can't control it. But someone else can. This chapter is here to strip away the noise, to simplify what others complicate. Because once you understand how blockchain really works, in plain English, you'll never see money, power, or digital ownership the same way again. Let's start with the basics. What is a blockchain? Really, at its core, a blockchain is just a digital record book, one that anyone can look at, but no one can easily change. Imagine a notebook. Every time something happens, a transaction, a message, a contract, it gets written into the notebook. Once a page is full, it gets sealed and added to a chain of previous pages. That chain of pages is the blockchain. Now imagine this notebook isn't kept in one place, but copied and shared with thousands of people around the world. Every time a new page is added, all of them get the same update at the same time. One person controls the notebook. And because everyone has a copy, no one can cheat by faking what's written in it. That's the magic. Why it matters, let's pause for a second. Why is this so important? Because for the first time in history, we have a way to record truth without trusting a middleman, and no need for a bank to verify payments. No need for a lawyer to verify a contract. No need for a corporation to manage your identity. The blockchain does it all, automatically, transparently, and permanently. You don't need permission. You don't need to beg a gatekeeper. The system works because it's built to work, not because someone in charge says it does. That's power. Breaking down the buzzwords, let's simplify some of the most common terms you'll hear in the crypto space. A block is just a group of data, like a digital page in our notebook. It contains a list of transactions or actions. Chain blocks are linked together, one after the other, to form a timeline. Once a block is added, it's nearly impossible to change without altering every block that came after it. Decentralized, this means the blockchain isn't stored in one location. It lives on thousands of computers, called nodes, all around the world. That way, no single person or company can control it. Immutable. Once data is written to the blockchain, it can't be altered or deleted. It becomes a permanent part of history. Consensus. This is how all the computers in the network agree on what's true. Different blockchains use different systems, like proof of work or proof of stake, to reach consensus and stay honest. Still, with me? Good. You're already ahead of 90% of people out there. Why they make it sound complicated now? Here's the part they don't want you to realize. Blockchain is disruptive. It threatens old systems. Banks can't charge fees when people send money directly. Middlemen lose power when smart contracts replace lawyers. Tech giants can't hoard your data when you own your identity. So how do they protect their control? They confuse you. They flood the internet with technical terms. They make blockchain sound like something only geniuses can understand. But now you know better. Blockchain is just a tool, a system of trust without trusting anyone. It's the foundation for a future where power is more evenly distributed. And that scares some people. Real-world examples. Blockchain in action. Let's bring this home with a few simple, real-world uses of blockchain that are already happening. Right now, money transfers without banks. With Bitcoin, people can send money across the world in minutes, without a bank account or government approval. No delays, no high fees, just peer-to-peer value. Smart contracts. Ethereum allows developers to write code that executes automatically, like a vending machine. For example, rent can be paid through a contract that releases access only when the payment is confirmed. Digital identity. Instead of logging in with a username and password, people can use blockchain-based identity wallets, secure, private, and controlled by the user. Supply chain transparency. Companies are using blockchain to track where products come from, coffee beans, diamonds, vaccines, to prove authenticity and prevent fraud. Voting systems. Blockchain has the potential to eliminate voting fraud by creating transparent, tamper-proof records of every vote cast. And this is just the beginning. What you should watch out for. Not everything with the word blockchain is legit. Some projects slap the term on just to sound futuristic. Others build overly complex systems that don't need a blockchain at all. Always ask, does this actually need a blockchain? Who controls it, really? What problem does it solve? And for whom? Remember, just because something uses the word doesn't mean it holds the values of transparency, decentralization, and truth. Chapter 3. Wallets, keys, and custody. Your crypto, your rules. Let's get straight to the point. If you don't control your private keys, you don't own your crypto. That may sound dramatic, but it's the cold truth in this space. And yet, Most beginners don't realize this until it's too late, until an exchange locks their account, freezes withdrawals, or gets hacked. Crypto is built on the idea of financial freedom. But freedom without responsibility is just another trap. In this chapter, we're going to break down one of the most important parts of crypto: wallets, private keys, and self-custody. This is where real ownership begins, and where most people either level up or lose everything. Let's make sure you're in the first group. What is a crypto wallet? A crypto wallet isn't like the one in your pocket. It doesn't physically hold your crypto. Instead, it stores the keys that give you access to your coins on the blockchain. Think of it like this: your coins live on the blockchain. Your wallet stores the keys that prove those coins belong to you. There are two main parts to every crypto wallet: public key, like your bank account number. You can share it with anyone to receive funds. Private key, like the PIN to your vault. This must be protected at all costs. Whoever has your private key has full control over your funds. No password resets, no customer service, no takebacks. If that's the power and the risk. Types of wallets. Hot versus cold. All crypto wallets fall into two categories: hot wallets and cold wallets. Let's break them down. Point 1. Hot wallets, connected to the internet. These are software-based wallets that live on your phone, computer, or browser. Examples: mobile apps like Trust Wallet or MetaMask, browser extensions, exchange wallets. More on this in a moment. Pros: easy to use, fast access to your crypto. Great for beginners and everyday transactions. Cons: always online equals always vulnerable, prone to hacks, phishing, malware. Hot wallets are like carrying cash. Convenient, but not ideal for storing large amounts. Point 2. Cold wallets. Offline, hardware-based. Cold wallets store your keys offline, disconnected from the internet. This makes them nearly impossible to hack, unless someone physically gets the device and your PIN code. Examples: hardware wallets like Ledger or Trezor, paper wallets. Your keys printed and stored offline. Pros: maximum security, ideal for long-term storage. Cons: more setup required, less convenient for frequent trading. Think of cold wallets as a personal vault, harder to access, but much safer. Exchange wallets. The illusion of ownership. Let's talk about the elephant in the room: centralized exchanges. Platforms like Binance, Coinbase, or Kraken. When you buy crypto on an exchange and leave it there, it feels like yours. You can see it, you can trade it, you can even withdraw it, as long as the platform allows it. But here's the harsh reality: you don't control the private keys. That means the exchange can freeze your account, limit withdrawals, be hacked, go bankrupt, and when that happens, your coins are gone. Just ask users of FTX, or MTGOX, or QuadraGCX. This is why the crypto community repeats one phrase like a mantra: not your keys, not your coins. It's not a slogan. It's a warning. What is self-custody and why it matters? Self-custody means holding your private keys yourself, not trusting a third party. It's the purest form of crypto ownership. When you control your keys, you don't need permission to move your funds, use DeFi platforms, participate in governance, exit the financial system. You're truly in charge. But with great power comes great responsibility. If you lose your keys or recovery phrase, no one can help you. That's the trade-off: freedom or dependence. You choose. How to set up your own wallet, step by step. Here's a simple, safe way to start practicing self-custody. Choose a wallet. Start with a beginner-friendly hot wallet like MetaMask, Trust Wallet, or Exodus. Install the app, download it from the official website or app store. Be cautious of fake apps. Write down your recovery phrase. You'll be given 12 or 24 words. Write them on paper, not in your phone or computer. Store this paper somewhere secure. This phrase can restore your wallet if you lose your device. Send a small amount first. Test the wallet by sending a small amount of crypto. Learn how it works before moving larger amounts. Upgrade to a hardware wallet once you're ready to store more. Buy a hardware wallet like Ledger or Trezor. Follow the instructions carefully and never share your recovery phrase. Practice responsible storage. Keep backups of your keys and phrases in safe, offline places. No screenshots, no cloud storage. This might sound like a lot, but it's easier than you think. And the confidence it gives you is worth everything. Common mistakes to avoid: saving your seed phrase on your phone or cloud drive. Hackers love that. Using exchange wallets for long-term storage. Too risky. Sending funds to the wrong blockchain. Always double check. losing your recovery phrase. Without it, your funds are lost forever. Crypto punishes carelessness, but it rewards caution, discipline, and learning. Chapter 4: Exchanges and Manipulation. Where the game gets rigged, you might think of crypto exchanges as neutral platforms, just places where you buy and sell. Simple, right? Not quite. Crypto exchanges, especially centralized ones, are not just middlemen. They're gatekeepers, and sometimes they're predators. They shape markets, set prices, move liquidity, and in some cases, quietly manipulate the game to benefit themselves. While making sure you stay in the dark. In this chapter, we're going to open your eyes to how exchanges really work, the parts they don't advertise. From hidden fees to shady practices, you'll learn how the system is designed to profit off of your ignorance. And most importantly, you'll learn how to navigate it with your eyes wide open. What is a crypto exchange? Let's start simple. A crypto exchange is a platform that lets you buy, sell, and trade cryptocurrencies. Some allow fiat to crypto, like USD to Bitcoin, while others focus only on crypto-to-crypto trades. There are two major types: centralized exchanges, CXs, platforms like Binance, Coinbase, Kraken; decentralized exchanges, DEXs, platforms like Uniswap, PancakeSwap, and DYDX. Each comes with its own risks and benefits. But centralized exchanges are where most of the manipulation happens, and that's where we'll focus first. The illusion of trust at first glance. Centralized exchanges seem trustworthy. They have sleek apps, fast trades, customer support, insurance, big-name sponsorships. They look and feel like banks or stock trading platforms. But here's the twist: you're not in control. They are. They hold your private keys. They decide which tokens you can buy. They can freeze withdrawals at any time. And they can manipulate the market from inside the walls. These platforms are businesses. Their goal is not to make you rich. Their goal is to maximize their profit, even if it comes at your expense. How the game gets rigged. Let's break down some of the most common tactics exchanges use behind the scenes. Point 1. Wash trading. This is when an exchange, or bots on it, buy and sell the same asset back and forth to create fake trading volume. It makes a token look more popular than it really is, luring in unsuspecting investors. Why do this? Because volume equals attention, and attention equals new users and more trading fees. Point 2. Front-running. In traditional finance, front-running is illegal. In crypto, it's rampant. Exchanges or insiders can see your trades before they execute and place their own ahead of yours to profit from your move. You pay more, they make more. It's legal robbery, hidden in plain sight. Point 3. Fake listings and pump promotions. Some exchanges accept payment from shady projects to list their tokens, then push them to users as new opportunities. Once the price is pumped through hype, insiders dump their tokens, and the public is left holding the bag. They call it marketing. You experience it as a loss. Point 4. Liquidity manipulation. Exchanges can move liquidity between tokens or limit access to assets to influence prices. Ever tried to withdraw a coin and suddenly the withdrawal is under maintenance? That's not always a technical issue. It's a form of control to protect their internal positions or manage their exposure. Point 5. Outages at convenient times. Many major exchanges have a pattern. They go down during massive market crashes or spikes. Suddenly, you can't buy, sell, or move funds just when it matters most. Technical glitch. Maybe, but it always seems to benefit the exchange, not the user. Centralization risks. Let's not forget the bigger risk: custodial failure. When you leave funds on a centralized exchange, you trust that they won't get hacked. They won't go bankrupt. They won't block your account. They won't vanish overnight. But history tells another story. FTX, Mt. Gox, Celsius, Voyager, billions lost, users locked out, promises broken, and every time, the people who lost the most were the ones who trusted too easily. What about decentralized exchanges? Decentralized exchanges, DEXs, are different. They let you trade peer-to-peer directly from your own wallet, without giving custody to a third party. No accounts, no gatekeepers, just code. Pros: you stay in control of your funds. No KYC or account suspension risks. Fully transparent, trades are on-chain. Cons: no customer support. Limited tokens on smaller chains. Higher learning curve for beginners. More responsibility on you to avoid scams and fake tokens. The AXs are powerful, but they require education and caution. Your trading freedom for complexity. How to protect yourself as a trader. Let's shift from fear to action. Here's how. To move smart in a world of exchange manipulation. 1. Don't leave large amounts on exchanges. Withdraw to your personal wallet whenever possible. Use exchanges like you'd use a public restroom. Get in, get out. Point 2. Use limit orders, not market orders. Market orders can be exploited. With limit orders, you set the price, not the exchange. Point 3. Track real liquidity, not just volume. Check platforms like CoinGecko or DeFi Llama for real, audited data. Point 4. Study token contracts before trading on DEXs. Fake tokens can have similar names. Verify everything. Point 5. Watch for red flags, unexpected outages, long withdrawal times, or aggressive marketing should raise questions. Point 6. Diversify across platforms. Don't put all your crypto eggs in one basket or on one exchange. Chapter 5. Hidden altcoin gems versus shiny scams. Bitcoin may have started it all, but it didn't end there. Today, there are over 25,000 cryptocurrencies and counting. Some are quietly changing the future of finance, gaming, identity, and data. Others, they're digital junk, flashy logos, empty promises, and no real value underneath. This is the double-edged sword of altcoins. For every hidden gem that could 10x or even 100x your investment, there are 100 shiny scams designed to take your money and disappear. This chapter will give you the tools to tell the difference. No hype, no guesswork, just smart analysis and clear red flags. Because the next opportunity is out there, but only if you know how to find it without getting burned. Let's sharpen your instincts. What are altcoins? Altcoins are simply alternative coins, any crypto that isn't Bitcoin. Some of the biggest names you'll hear include Ethereum, ETH, smart contract platform Solana, SOL, Fast, scalable blockchain Chainlink, Link, Oracle Network connecting real-world data Polkadot, DOT, interoperability-focused blockchain Avalanche, AVAX, high-speed decentralized apps platform. And then there's the long tail, thousands of smaller projects with names you've probably never heard of. Yet, some of them are solving real problems in finance, healthcare, gaming, even identity. Others exist only to extract your money before vanishing. The key is knowing how to separate signal from noise. Why altcoins exist. Altcoins aren't just clones of Bitcoin. Many were created to improve on it or do something entirely different. Ethereum introduced programmable money through smart contracts. Cardano focused on academic research and peer-reviewed development. Monero prioritized private, untraceable transactions. Filecoin created decentralized cloud storage. Each of these projects had a purpose, a use case, beyond just being another coin. That's your first rule. If a coin doesn't solve a real problem, it doesn't deserve your money. How to spot a hidden gem. Finding a good altcoin project isn't just luck, it's research. And while there's never a guarantee, here are the pillars of smart analysis. 1. Strong team and track record. Look at the founders. What have they built before? Are they public and transparent? Anonymous founders aren't always bad, but they raise risk. A real team with real-world credentials builds trust. Point 2. Clear use case. What real-world problem is this coin solving? Is it doing something better, faster, or cheaper than existing solutions? If it's just trying to copy Ethereum, ask why anyone would switch. Point 3. Working product or MVP. Is there a real, working platform, or just promises and mock-ups? A project with a working product, even in beta, shows progress. Point 4. Tokenomics and supply. How many coins exist? How are they distributed? Who controls most of the supply? If insiders hold most of the tokens, they can dump on the market and tank the price. Point 5. Community and developer activity. Is there an active, growing user base? Are developers building on it? You can check GitHub to see if code is being written. Dead code equals dead project. Point 6. Real partnerships and adoption. Are they being used by other platforms or companies? Are they listed on major exchanges or integrated into real products? 7. Security and audits. Has the project been audited by a third party? Bugs and exploits can kill even the best ideas. Gem projects don't just have a dream. They have evidence. The anatomy of a shiny scam. Now, let's flip the coin. Scam tokens are everywhere, and they're getting more sophisticated. But the red flags are still easy to spot if you know where to look. Point 1. No clear use case. If the project can't clearly explain what it does in a sentence, run. Vague buzzwords like revolutionizing the blockchain ecosystem mean nothing. Point 2. Anonymous or unverified team. Scam projects often hide behind stock photos, fake names, or completely anonymous teams. Transparency is your first layer of safety. Point 3. Token with no utility. If the only purpose of the token is to pump and trade it, it has no long-term value. Real tokens fuel ecosystems. Scam tokens just exist to flip. Point 4. High marketing, no product fuel. See fancy websites, paid influencers, flashy white papers, but no working app, no users, and no actual function. Point 5. Guaranteed returns. Any coin that promises guaranteed profits, passive income, or fixed yield is a scam. Period. Crypto is risky, always has been. Point 6. Liquidity traps and fake volume. Scam coins often have low liquidity, so when you try to sell, you can't. Or they lock you in with fake rules like you must hold for 30 days. That's a red flag. Point 7. Rug pull patterns. Look for sudden price spikes followed by fast crashes, often after a wave of influencer marketing. This is a classic pump and dump setup. Shiny scams don't want to build a future. They want to steal yours. Step by step. How to research an altcoin when you're considering a new token. Follow this checklist. Go to the official website. Check for transparency. Is the white paper detailed? Is the roadmap clear? Google the team. Look them up on LinkedIn, YouTube, and GitHub. Are they active and real? Check the token's contract. Use sites like Etherscan to look up the contract. Verify it's audited and clean. Join the community. Enter the project's Discord or Telegram. See how active and helpful the members are. Scam projects often have overhyped, hostile communities. Look at the chart history. If the price spiked hard after launch and has been dumping ever since, be cautious. Watch for red flags. Avoid projects with cult-like followers, vague roadmaps, and unrealistic promises. Smart altcoin investing principles. Start small. Treat altcoins like venture capital. High risk, high reward. Diversify. Don't put all your funds into one token. Avoid hype coins. If everyone is talking about it, you may be late. Exit wisely. Set profit-taking targets. Don't marry your coins. Track your entries and reasons. Keep a simple journal. Know why you bought something. Chapter 6. NFTs, hype, and what actually has value. Say the word NFT, and most people think of one thing. Overpriced cartoon animals. Maybe a monkey with sunglasses. Maybe a pixelated alien. Maybe some celebrity promoting their own collection. That's the image mainstream media ran with. And in some cases, rightfully so, there was hype. There were scams. There were rug pulls. But beneath the noise, there's something deeper, something most people completely missed. NFTs aren't about JPGs. They're about ownership. In this chapter, we'll cut through the noise and get to the truth. You'll learn what NFTs really are, why they matter, and how they could quietly reshape everything from art to gaming to real estate. And yes, we'll talk about the scams too. Because in a gold rush, the loudest voices are often the ones selling shovels. What is an NFT? Let's break it down. NFT stands for non-fungible token. That sounds complicated, but it really just means this. It's a digital item that is unique, provably owned, and can't be swapped one to one like a regular coin. Let's use an example. A Bitcoin is fungible. If I send you 1 BTC and you send me back 1 BTC, nothing's changed. But an NFT is like a concert ticket. Each one is unique. Each one has its own details, seat number, and value. NFTs live on the blockchain, and they act like digital certificates of ownership. They prove that you own something, whether it's a piece of art, a song, a game item, or even a real-world house. And that's where the power lies, beyond the art. What NFTs actually do. Let's forget the monkey pictures for a minute. Here's what NFTs can really be used for, and why you should care. Point 1. Digital art ownership. Artists can now sell their work directly to collectors. No galleries, no middlemen. And collectors can prove, forever, that they own the original piece. The blockchain makes that proof permanent. Point 2. Music and royalties. Musicians can release albums or singles as NFTs, giving fans ownership and access, and even share royalties directly with their community. No record label needed. Point 3. Gaming and virtual assets in game items, weapons, skins, land, can be minted as NFTs. That means players can truly own, trade, or sell what they earn in a game. Imagine buying a sword in a game and being able to sell it for real money outside that game. Point 4. Tickets and access passes, concerts, conferences, VIP clubs, all can issue NFT-based tickets. These are harder to fake, easier to verify, and can carry extra perks like exclusive content or future discounts. Point 5. Identity and credentials. NFTs can represent who you are, your medical records, degrees, certifications, all in your control, not stored in some private server. Point 6. Real estate and legal ownership. Some startups are working on tokenizing real-world property. That means owning a house or land could be linked to an NFT, making transfers faster, cheaper, and legally verified. On-chain NFTs are about what's behind the token, not the image you see. The hype phase. What went wrong? Let's not sugarcoat it. The NFT space in 2021 and 2022 was wild. Projects raised millions overnight. Celebrities launched their own collections, often without understanding what they were selling. People bought tokens they didn't even like, hoping someone else would pay more. It was pure speculation. The digital version of flipping baseball cards, except with price tags in the thousands. And when the music stopped, many NFT projects collapsed. Users were left holding worthless tokens. Scammers vanished with millions in Ethereum. Why? Because most buyers didn't care about utility or value. They just wanted quick profits. The lesson is simple. NFTs aren't scams, but hype-driven NFTs often are. How to tell the difference? Here's how to spot real NFT value versus empty hype. Real value projects have a clear use case, access, utility, ownership, offer community involvement, not just buyers, but builders, provide long-term benefits like royalties, upgrades, or real-world perks, are transparent about their team and their roadmap, have genuine demand, not fake Twitter followers or paid influencers. Hype-driven or scam projects rely on flashy marketing, but no real product. Promise floor price will moon instead of actual utility. Use FOMO tactics, only 100 spots left. Mint now or miss out forever. Hide behind anonymous teams with no accountability. Vanish after launch, leaving holders with nothing. When you evaluate an NFT project, ask this: would this still be valuable if I couldn't resell it tomorrow? If the answer is no, think twice. Step by step. How to explore NFTs safely. Start on trusted marketplaces. Use OpenSea, Blur, Magic Eden, or LooksRare. Avoid random websites you find through ads. Verify the collection. Scammers often create lookalike projects. Double-check links from official sources. Use a burner wallet when exploring new projects. Use a separate wallet with limited funds. Never connect your main wallet to untrusted sites. Join the community. Read the Discord. Follow the Twitter. Are people engaged? Or is it full of bots and hype? Understand the utility. What does the NFT actually do? If it's just a picture, it better be by a real artist. If it's for access or rewards, verify those benefits. Avoid emotional FOMO. Just because it's selling out fast doesn't mean you're missing out. Often, that's when you're most likely to be targeted. NFTs in 2025, where things are heading. NFTs are moving beyond speculation and into the infrastructure of the digital world. Here's what's on the horizon. Soulbound NFTs, tokens that represent non-transferable identity data like your medical records or academic degrees. NFT subscriptions, access to content, courses, or memberships that can be managed and sold by users. NFT-backed loans. Use your NFTs as collateral for real crypto loans. Tokenized real estate and IP, fractional ownership of assets. Through NFTs, the hype is dying, and the real innovation is quietly taking its place. Chapter 7. Crypto in the Real World. It's closer than you think. When people talk about crypto, they often imagine it as something distant, something futuristic, something abstract. Digital coins, online speculation, internet money. But what if I told you crypto is already here, quietly working behind the scenes, changing the way we pay, earn, save, move, and even govern? This chapter will open your eyes to how blockchain and cryptocurrency are already embedded in the real world. Not tomorrow, not someday, But right now that you'll see how crypto is quietly powering real businesses, solving real problems, and redefining what financial independence actually looks like. And after this chapter, you'll stop asking, will crypto go mainstream? And start realizing it already has. Digital payments and stablecoins. Crypto's first real utility. Let's start with something basic: sending money. Millions of people around the world use stablecoins like USDT and USDC to send and receive payments every day. Why? Because stablecoins are fast, settle in minutes, not days, cheap. Often just a few cents in fees, borderless. No banks, no limits, no delays, stable. Pegged to the dollar, not volatile like Bitcoin in countries with inflation or broken banking systems like Argentina, Venezuela, Nigeria, or Turkey. Crypto isn't a luxury. It's a lifeline. People use stablecoins to pay freelancers, store savings, escape inflation, send remittances to family abroad. No permission, no middlemen, no nonsense. This is crypto as it was meant to be: practical, powerful, free. The rise of crypto-friendly business assets, not just individuals. More and more businesses, big and small, are integrating crypto into their daily operations. Some real-world examples. Starbucks lets users earn rewards through blockchain-based programs. Visa and MasterCard now issue crypto-backed cards. Shopify merchants can accept crypto directly via integrations with Coinbase and BitPay. Luxury brands like Gucci and Tag Heuer accept crypto payments in select locations. airBaltic, Cheap Air, and Travala let users book flights and hotels with crypto. Even charities now accept crypto donations, faster, cheaper, and with better transparency. What started as a fringe movement has now entered the boardroom, and the more people use it, the more accepted it becomes. Blockchain and government, healthcare, and ID systems, it goes deeper. Governments and institutions are starting to explore blockchain for things far beyond currency. Land registries. In countries like Georgia and Sweden, blockchain is used to record land ownership, preventing fraud and corruption. Digital IDs. Projects in Estonia and India are exploring blockchain-based identity systems to reduce paperwork and increase security. Healthcare records. Trials are underway in countries like the UK to use blockchain to store medical data that's secure, portable, and tamper-proof. Voting. Blockchain-based voting systems are being tested to increase transparency and reduce fraud, with pilot programs in places like Utah and Sierra Leone. These aren't headlines. They're real-world applications happening now, often without anyone even realizing it's blockchain behind the scenes. Banking. The unbanked. Crypto as a human right. Over 1.4 billion people in the world today are unbanked, meaning they have no access to a traditional bank account. Why? Because they live in the wrong place, don't have the right documents, or simply can't afford the fees. Crypto changes that. All you need is a smartphone and internet access, and suddenly you can store value, safely send and receive money, access loans and savings, participate in a global economy. This is especially powerful in developing countries, where access to even the most basic financial tools can transform lives. Crypto doesn't care where you were born. It doesn't discriminate. And it doesn't ask for permission. But that's not just innovation. That's inclusion. The gig economy meets Web3. Let's talk about how people are earning with crypto, not just investing. Enter the Web3 gig economy. Millions of users are already earning crypto by completing microtasks on platforms like CoinMarketCap, or Layer 3 getting paid for writing, translating, and designing on decentralized platforms like Braintrust and Talent Layer, creating and selling content directly to their audience using NFTs or crypto subscriptions. Participating in learn-to-earn and play-to-earn platforms that reward users in tokens for engagement. This is a future where your labor, time, and attention are no longer funneled into someone else's ad system. You earn, you own, you choose. Real estate, logistics, and supply chains. Blockchain is even changing how we move goods and buy property. IBM and Maersk use blockchain to track global shipping containers, reducing delays and fraud. Walmart uses blockchain to trace food from farm to shelf, improving safety and recall speed. Real estate tokenization platforms like Realty and Propy allow fractional ownership of physical property via blockchain. Deeds and titles can be recorded on-chain, making buying and selling property faster, safer, and less dependent on bureaucracy. This isn't theory. These systems are live, tested, working, and they're spreading fast. Everyday experiences, quietly powered by blockchain. You might not even notice it, but blockchain is powering apps and services you use or will use soon. Web browsers like Brave reward you for viewing ads with their native token. Streaming platforms like Audiobook let artists earn directly from listeners. Gaming companies are building play-to-own economies where your progress and assets are truly yours. The infrastructure is growing. Quietly, consistently, and one day soon, people will use crypto without even knowing it's crypto. Just like how you use the internet without thinking about TCP/IP. Chapter 8. Tax, regulations, and loopholes. They hope you don't learn. Crypto has opened doors to new financial freedoms. But with freedom comes scrutiny. Governments worldwide are waking up to the power of digital assets. They want their share, their control, and their oversight. Tax laws are evolving, regulations are tightening, and the rules of the game are changing fast. If you want to play this game smart, you need to understand the landscape. You need to know what the regulators want, what they're watching, and where the cracks are. The loopholes they hope you never find. In this chapter, we'll explore the complex, often confusing world of crypto tax and regulation. You'll learn how to stay compliant without overpaying and how to protect your wealth legally. Because ignorance isn't bliss, it's expensive. The growing regulatory landscape. A decade ago, crypto was mostly ignored by tax authorities and regulators. Not anymore. Today, almost every major economy has some form of crypto regulation. Some are friendly, some are restrictive. Most are somewhere in between, trying to catch up with lightning-fast innovation. Here's what's happening. Governments want transparency. They're demanding exchanges and wallets report user activity. Many countries require users to declare gains on crypto transactions. Some jurisdictions treat crypto like property, others as currency, and some as securities. Anti-money laundering, AML, and Know Your Customer, KYC, laws are becoming standard for exchanges. New rules are being proposed to regulate DeFi, NFTs, and cross-border payments. The regulatory landscape is a moving target, but ignoring it is not an option. Crypto taxes. What you need to know. Taxes on crypto can be complicated because they vary widely depending on where you live and what you do with your coins. Here are the common tax events you should be aware of. 1. Selling crypto for fiat. This is the most obvious event. When you sell Bitcoin or Ethereum for dollars, euros, or any government currency, you trigger a taxable event. Usually, you owe capital gains tax on your profit. Point 2. Trading one crypto for another. Even swapping one coin for another can be taxable. For example, exchanging Bitcoin for Cardano is often treated like a sale of Bitcoin at market value, which may create a gain or loss. Point 3. Using crypto to buy goods or services. Spending crypto is also a taxable event. If the coin appreciated since you bought it, you owe tax on the gain at the moment of purchase. Point 4. Mining and staking rewards. Income from mining or staking is often taxed as ordinary income at the time it's received. Later, when you sell those coins, you might owe capital gains on their appreciation. Point 5. Airdrops and forks. Coins received for free through airdrops or blockchain forks may be considered taxable income based on their fair market value at receipt. The challenges of compliance. Crypto's decentralized and pseudonymous nature makes compliance tricky. Tracking every transaction across multiple wallets and exchanges is complicated. DeFi platforms and peer-to-peer trades often lack formal reporting. International transactions cross borders and regulatory regimes. Many users are unaware of the exact reporting requirements. Because of this, tax authorities are investing heavily in blockchain analytics firms, companies that trace transactions, identify wallet owners, and uncover hidden gains. Simply put, the days of flying under the radar are numbered. Legal strategies and loopholes they don't want you to know. While it's critical to stay compliant, there are smart legal strategies to minimize your tax burden, and these are often not well publicized. Here are a few to consider. 1. Tax loss harvesting. This involves selling losing positions to offset gains and reduce your taxable income. You can then rebuy the asset after a short period. It's a strategy long used in traditional markets, and it works in crypto. 2.2. Long-term holding. Many countries offer lower tax rates for assets held longer than a certain period, typically over a year. Holding coins for the long term can significantly reduce taxes on profits. Point 3. Gifting crypto to family or friends can sometimes bypass capital gains tax, especially if the recipient is in a lower tax bracket. Be sure to check local laws. Point 4. Using tax-advantaged accounts in some jurisdictions, you can hold crypto inside retirement or tax-advantaged accounts, deferring or eliminating tax liabilities. Point 5. Offshore structures and residency. Some investors use offshore entities or establish residency in crypto-friendly countries to reduce their tax burden. This requires expert legal advice and strict compliance. Point 6. Donating crypto to charity. Donating appreciated crypto to a registered charity can provide tax deductions while avoiding capital gains taxes. Regulatory risks and what to watch for. Regulations can change quickly and sometimes retroactively. Here are risks to keep an eye on. New reporting requirements that increase your compliance burden. Bans or restrictions on certain types of crypto activity, like DeFi or privacy coins. Increased AML/KYC checks that may limit privacy and access. Tax audits focused on crypto activity. Legal uncertainty around new crypto instruments. Staying informed is your best defense. Tools and resources for crypto tax management. Thankfully, technology is catching up. Crypto tax software like CoinTracker, Coinly, and TokenTax can automatically import your trades, calculate gains, and generate tax reports. Professional advice. Tax accountants specializing in crypto are worth the investment. Keeping meticulous records of all transactions, dates, amounts, and wallets is essential. Following official government guidance and updates regularly. Preparation and transparency are key. Chapter 9. The psychology of a winning crypto investor. Investing in crypto isn't just about charts, wallets, or technology, but it's about mindset. The true edge in crypto isn't the latest token or algorithm. It's how you think, how you react, and how you manage your emotions in a market that never sleeps and often swings wildly. In this chapter, we'll explore the psychology behind winning crypto investors, what sets them apart from the rest, why they avoid common pitfalls, and how you can develop a resilient mindset that keeps you calm, focused, and successful. Because in crypto, your mind is your most valuable asset. The emotional roller coaster of crypto. If you've spent any time trading or investing in crypto, you know this. The markets move fast, sometimes shockingly fast. Prices soar, then crash. Headlines explode. FOMO creeps in. Fear and greed wage war in your brain. Every day can feel like a roller coaster, with adrenaline spikes and gut-wrenching drops. For most, this emotional volatility leads to mistakes. Buying high during euphoric hype, selling low during panic crashes, chasing the latest hot coin, ignoring strategy and discipline. But winning investors understand something crucial. Emotions are the enemy of consistent profits. Key psychological traits of successful crypto investors. Let's look at the mindset traits that define winners. 1. Discipline. They have clear plans. Entry points, exit points, position sizes. They don't deviate because of headlines or hype. Point 2. Patience. They know success isn't about quick flips. It's about long-term trends, holding through volatility, and waiting for the right opportunities. Point 3. Emotional control. They don't let fear or greed drive decisions. They recognize these feelings and act deliberately, not reactively. Point 4. Curiosity and learning. They continuously educate themselves about technology, markets, and psychology. They don't believe they know everything. Point 5. Adaptability. Crypto markets evolve rapidly. Winners pivot when conditions change. They don't cling to old ideas or coins that no longer work. Point 6. Humility. They accept losses as part of the game. They don't let ego dictate decisions. They learn from mistakes rather than deny them. Common psychological pitfalls and how to avoid them. Let's dig into the traps that catch most investors and how to steer clear. Pitfall 1. FOMO, fear of missing out. Seeing coins skyrocket can push you to buy impulsively. Instead, develop a checklist for every trade. Ask, does this fit my plan? What's the risk? Pitfall 2. Overconfidence. After a few wins, it's easy to feel invincible. Beware, overconfidence leads to reckless bets. Stay humble and stick to your strategy. Pitfall 3. Loss aversion. The pain of losing feels stronger than the joy of winning. This can cause you to hold losing positions too long or exit winners too early. Set stop losses and profit targets in advance. Pitfall 4. Confirmation bias. You might seek information that supports your view and ignore warnings. Challenge your beliefs regularly. Play devil's advocate. Pitfall 5. Herd mentality. Just because everyone is buying a coin doesn't mean it's a good investment. Independent research beats groupthink every time. Building a winning crypto mindset. Practical tips. Here's how to develop the psychology of success. Create a trading plan. Write down your goals, risk tolerance, entry/exit rules, and stick to them. Use journaling. Keep a trading journal. Record why you made each trade, how you felt, and the outcome. Reflect weekly. Practice mindfulness meditation, breathing exercises, or simple pauses before decisions can reduce emotional reactivity. Limit exposure. Don't put all your capital in volatile assets. Diversify to reduce stress. Set realistic expectations. Crypto is exciting but unpredictable. Aim for steady growth, not overnight riches. Learn from mistakes. Every loss is a lesson. Analyze what went wrong without self-judgment. Take breaks. The market never sleeps, but you should. Step away to recharge and avoid burnout. The role of risk management in psychology. Risk management isn't just math. It's psychology in action. By controlling how much you stand to lose on any trade, you protect your emotional state. That if one loss won't break you, you stay calm and objective. Set maximum loss limits per trade and per day. Use stop-loss orders. Keep position sizes small relative to your total portfolio. This creates a mental cushion, allowing you to think clearly and avoid panic decisions. Cultivating a growth mindset. Successful crypto investors see themselves as students, not masters. Markets change, technology evolves, and so should you. Embrace challenges. Seek feedback. Be willing to adjust your strategy. The best investors know that consistent learning and adaptation are the true keys to long-term success. Chapter 10. The 2025 Blueprint. Turning crypto into freedom. You've journeyed through the world of crypto, from hidden histories and technology to mindset and regulations. Now it's time for the ultimate question. How do you turn this knowledge into real freedom? Freedom from financial stress. Freedom from gatekeepers. Freedom to live life on your own terms. This chapter lays out your 2025 blueprint, a step-by-step guide to leveraging crypto's power to build lasting wealth, protect your future, and claim your independence. No hype. No shortcuts. Just smart, proven strategies you can apply today. Let's build your future. Step 1. Master the fundamentals. Knowledge is your foundation. Before you dive into investments or trading, make sure you understand blockchain technology and how cryptocurrencies work. Know how to safely store and secure your assets with wallets and keys. Learn the risks involved, including market volatility and scams. Stay informed about regulations and tax responsibilities. This foundation will keep you steady when markets turn chaotic. Step 2. Create a clear plan with goals. Success begins with clarity. Ask yourself, what does financial freedom look like for me? How much do I want to build, and by when? What is my risk tolerance? How much time and effort can I commit? Write down your goals and break them into monthly, quarterly, and yearly targets. A clear plan will keep you focused and prevent impulsive decisions. Step 3. Build a diversified crypto portfolio. Diversification is your safety net. Don't put all your eggs in one basket. Allocate capital across Bitcoin, Ethereum, and established altcoins with solid fundamentals. Include stable coins to balance volatility and provide liquidity. Explore small allocations in promising new projects, but do your research. Consider crypto-related stocks or ETFs for additional exposure. Regularly review and rebalance your portfolio to match your goals and market conditions. Step 4. Use dollar cost averaging, DCA. Trying to time the market perfectly is a losing game. Instead, invest fixed amounts at regular intervals, weekly, bi-weekly, or monthly. This strategy smooths out price swings and reduces emotional stress. Over time, DCA helps you accumulate assets without chasing hype or panic selling during dips. Step 5. Leverage passive income opportunities. Crypto isn't just about buying and selling. Use your holdings to generate passive income. Stake coins on trusted platforms to earn rewards. Provide liquidity in decentralized exchanges carefully to collect fees. Explore lending your crypto through reputable protocols. Participate in yield farming with caution and proper research. Passive income can grow your portfolio steadily, even when markets are quiet. Step 6. Protect yourself. Security and compliance. Your assets are only as safe as your security practices. Use hardware wallets for long-term storage. Enable two-factor authentication on exchanges. Beware of phishing scams and suspicious links. Keep backups of your seed phrases offline. Stay compliant with tax laws and report earnings accurately. Protection isn't optional. It's the foundation of freedom. Step 7. Cultivate the winning mindset. Remember Chapter 9 that success in crypto requires discipline to stick to your plan, patience during volatility, emotional control to avoid impulsive moves, continuous learning and adaptation. Your mindset is your strongest asset. Step 8. Engage with the crypto community. You are not alone. Join forums, social media groups, and local meetups. Learn from experienced investors and developers. Stay updated on new trends, tools, and opportunities. Community support fuels growth and sharpens your insights. Step 9. Prepare for the unexpected. Crypto markets are volatile, regulations change, and new technologies emerge. Build a financial safety net outside crypto, emergency funds, insurance, and traditional investments. Keep an eye on regulatory developments and adjust your strategies accordingly. Be ready to pivot without panic. Step 10. Think long-term and stay committed. This is not a sprint. The path to crypto freedom is a marathon. Focus on building wealth steadily, protecting your gains, and evolving as the ecosystem grows. Your consistency and resilience will set you apart. Final thoughts. Freedom is within reach. Crypto offers more than money. It offers choice, control, independence. But freedom isn't given. It's earned with knowledge, discipline, and the right strategy. You can harness crypto's power to create a life where your finances serve you, not the other way around. The future belongs to those who prepare for it. And today, you're ready. Take this blueprint, make it your own, and step confidently into your crypto-powered freedom. Final chapter. The revolution will not be televised, but it will be tokenized. Change rarely announces itself with fanfare. Revolutions don't always explode on our screens with breaking news alerts or viral hashtags. Sometimes they unfold quietly, in code, in consensus, in digital ledgers running across the world. The crypto revolution is one of those silent but unstoppable forces. That it's not about flashy headlines or hype cycles, that it's about rewriting the rules. Who owns what, who controls money, and how power flows. This final chapter is a call to awareness, a reminder, and a challenge, because the future won't look like the past. It will be tokenized. What does it mean to be tokenized? At its core, tokenization means turning ownership, rights, and value into digital tokens on a blockchain. Think beyond money. Your identity, your property, your work, your reputation, your creativity, all can be represented, verified, and transferred securely, without middlemen or gatekeepers. The implications are profound. Decentralization, power to the people. For centuries, financial systems and governments have centralized control. Banks hold your money, corporations own your data, governments regulate and tax without direct accountability. Crypto and blockchain technologies flip this model on its head. They enable decentralized networks, where power is distributed across many participants. This means no single point of failure or control, greater transparency and trust through open ledgers, permissionless innovation, and access for anyone with internet. New models for governance, ownership, and community. It's a revolution of agency. Putting power back in your hands. The token economy. Redefining value. Tokens are more than assets. They are units of participation. In the token economy, contributors can be rewarded fairly for their work. Communities govern themselves through tokens representing voting rights. Creators monetize directly without intermediaries. Users earn ownership in platforms they help build. This new economy challenges traditional hierarchies. It rewards collaboration, creativity, and shared success. The cultural shift. Tokenization isn't just technical, it's cultural. It's about redefining how we relate to value and trust. It encourages openness over secrecy, inclusivity over exclusion, transparency over opacity, empowerment over dependence. This shift will affect everything from art and music to finance, governance, and beyond. Your role in the revolution, you are not a spectator. You are an active participant. By learning, investing, creating, and engaging responsibly, you become part of this transformation. Every wallet you control, every token you own, every decision you make contributes to the new decentralized world. The revolution will not wait. Looking ahead, challenges and opportunities. Like any revolution, this one faces hurdles, regulatory pushback, and uncertainty, technical scalability, and security challenges, misinformation and scams, environmental concerns. But history shows that true revolutions are resilient. They adapt, grow, and endure because they meet real needs: freedom, fairness, and opportunity. Closing thoughts. Beyond the hype, the crypto revolution isn't a fad or a bubble, that it's a fundamental shift in how we think about ownership, money, and trust. That it's a quiet, powerful wave building beneath the surface. That IT won't be televised, but it will be tokenized. And it's already happening. So the question isn't if you should be part of it, that it's how. Final call. Take your place, step into this new world with eyes wide open. Stay curious. Stay disciplined. Stay ethical. Use the tools you've learned to protect yourself and build real wealth. Share knowledge. Support innovation, because the revolution is yours to shape. The future is tokenized, and it starts with you.